So Salman, seeing as how you're an American living in Europe, I wanted to get your thoughts on the difference in conditions we've seen between the two economies lately and what that means for markets.
Yeah, that's something I've been thinking about as well. Obviously, there's been a massive divergence in the vaccination programs between the US and continental Europe. The US is now fully vaccinated nearly 20% of its population versus around 5% for most European countries. It's also administering vaccines at nearly 3 times the pace of European countries. This has meant that while the US is on an upward trajectory with the economy heading towards opening up, Europe is heading in the other direction, back to lockdowns and restrictions. And we see this clearly in expectations for growth. Check out this chart of economists' forecasts for growth in the two economies. It tells the story in stark terms. One economy is likely to be booming this year, the other will have a tougher time.
Yeah, it's a dramatic difference that we've seen already in markets. While US 10-year yields are up 75 basis points this year, German bond yields are up only 25 basis points.
Right. However, break-even inflation rates in Europe have risen in line with the US, at least this year. Both economies have seen 10-year break-even inflation rates rise up by about 40 bips, even though European rates are starting at a lower level.
Yeah, that's interesting. While it's true that there are base effects and that US break-evens had picked up more last year after Biden's win, the COVID-really stimulus, vaccine success, which really has happened over the last couple of months as well, a potential infrastructure package haven't widened the spreads with Europe.
That's a key reason why I think playing the inflation theme in break-evens is best expressed via the US. There are a lot of tailwinds there, whereas European break-evens have their share of headwinds. And the market action has treated inflation risk similarly in the two economies.
Right. And if that plays out, we should expect nominal yields to diverge further. But where else do you think we can see this divergence play out?
Well, I think currency markets are another great place to look. While you and I have talked before about longer-term headwinds for the US dollar, today's context is very different, at least when considering developed world peers. The US has the upper hand when it comes to growth differentials as well as nominal and real yields.
There is also supportive technical factors. For instance, positioning indicators suggest that investors aren't particularly long US dollar. CFTC data on currency futures, hedge fund betas, and broker-dealer reports all point in the same direction, that the dollar has room to go higher.
Exactly. I think there's a strong case to going long US dollar, especially against funding currencies like the euro, Swiss franc, and Swedish krona.
Cool, thanks Salman. It was helpful to step through how this divergence could play out in different markets.
Don't mention it. See you later.